Hi everyone, and welcome to our QCE Accounting Units 3 and 4 lecture for today. My name is Jess, but before I tell you a little bit more about me and we get into our content for today, I wanted to introduce you to ATAR Notes for those of you who may not be aware of everything that we do. So ATAR Notes started back in 2007, and since then we've been offering lots of free resources to students. And in 2015, the lectures became part of our offering. So we have lectures throughout the year, so make sure that you tune in to all of those different series and you can get a full picture of the syllabus for each of your different subjects as it progresses throughout the year. And we also have lots of other free resources on our website. So visit atarnotes.com and you'll be able to find all sorts of things that can help you in all of your different subjects. That can be study notes, discussion forums, videos, articles, ATAR calculators as well. So check out the website if any of those sound like they would be helpful to you. And if you need a little bit of extra help as well, we also have ATAR Notes Plus, which is something that is newer for us. As you can see, we've got a whole range of different textbooks that cover all of the content that you need to know for your different subjects. So I wrote both the business and accounting texts for our cohort for Queensland. So I definitely encourage you to access those if you want a better picture of everything in that written format. And it's something that I accessed back when I was at school for subjects like English too. So I encourage you to do that as well. Okay, so let's go into a little bit about me before we get started today. So as I mentioned, my name is Jess. I graduated back in 2020, so it's been a few years now, and I'm currently studying communication and journalism at the University of Queensland. So that's a 4-year dual degree, and I'm in my 4th and final year now. I also love reading and writing, so all of the humanities subjects at school were my favorite. I enjoyed English and I did legal studies, accounting, business, and ancient history. Okay, so let's get into what we're going to be covering in today's session. So this is all based on Unit 4, Topic 1. Now, depending on where you're at school, this may be something that you're about to go into for next term. It may be something that you won't get to until term 3. It depends on the way that your school has chosen to approach structuring the units in this subject. But either way, this content is definitely going to come up at some point for you in the near future. So regardless of where you're at school, this is going to be something that is going to be really handy. So if we follow the syllabus, then we see that bank reconciliation statements and cash budgets are a big part of that. So that's the first thing that we're going to be covering today. We'll look at statement of estimated receipts from accounts receivable, the statement of GST payable and receivable, input and report areas, and what if analysis. We'll look at computerized accounting processes and the syllabus requirements for analyzing, evaluating, and communicating. We'll have a look at your IA3, which is a cash management project, so it's an assignment, and then we'll finish off with some tips and advice. Okay, let's get started. So first of all, bank reconciliation. So the syllabus tells us that we need to be able to apply our accounting principles and processes, so handwritten and using spreadsheets as well, to prepare our bank reconciliation statement. So what is a bank reconciliation statement? So the whole idea of these statements is that they illustrate that the business's cash records align with the bank's records. So it's this checking idea where you want to have that consistency between the records of different organizations, and this procedure is going to involve ensuring that happens. So we adjust the final balance in the bank statement to account for the transactions that the bank didn't include in its records. So you can see we've got a bit of a 5-step process here. We're going to go through each of these steps individually, and then we're going to have a look at them applied to a worked example as well. But first, let's have a look at what happens when we've got different balances. So the structure of the bank reconciliation statement is going to depend on whether the final balance in the bank statement has a credit or debit nature. So it can be really easy to accidentally use the wrong structure in your bank reconciliation statement. So it's really important to get your head around which way to lay it out, depending on what that nature of the final amount in the bank statement is, credit or debit. So if it is a credit balance, then that shows that the bank owes the business money. So it would appear where you've got credit balance as per bank statement as your first line, with that total on the right hand side there. You would be adding your outstanding deposits, you would be subtracting your outstanding payments, and then you would have your debit balance as per the cash at bank account at the end there. Now, as opposed to this, if you have a debit balance, then that shows that the business owes the bank money, and we can call that a bank overdraft. And the bank reconciliation statement would show this by starting off with saying debit balance as per bank statement, so exactly the opposite to what our previous one said. Down the bottom, you can see we've got credit balance as per cash at bank account. So you're not going to have the same for each. So if the top says debit, the bottom should say credit, for example. It shouldn't be both debit and debit or credit and credit. In this case, we're adding outstanding payments and we're subtracting the outstanding deposits. So here is a bit of a summary of both. So a credit balance in the bank statement and a debit balance in the cash at bank. You need to add outstanding deposits and subtract those outstanding payments. And it's the opposite way around for the debit balance in the bank statement and the credit balance as per the cash at bank. You're adding those payments and then subtracting the deposits. Okay, so let's have a look at these steps that I mentioned earlier in a little bit more detail. So these are the steps that you need to follow to create that bank reconciliation statement. There's a bunch of things that you need to do in the lead up to actually figure out what figures to be putting into that statement. So it's about comparison between our different records. So that's the basis of our first 2 steps. The first step is comparing the bank statement's credit column with the listing of cash transactions debit column. And you also are looking at the bank reconciliation statement from the previous month if it has been provided. And when you're doing this comparison, you want to tick the items that correspond and identify any that have not been ticked, and then you make a note of those. Those are the ones that are going to then inform what you do later on in the process. And step 2 is just the opposite of that in terms of the different accounts. So instead of the credit column, you're looking at the debit column in the listing of cash transactions. And you are still looking at that previous bank reconciliation statement if it has been provided, and again doing that ticking process. Step 3 is about your general journal entries. So based on the information that you have gathered with those items that have not been ticked in the bank statement, you want to do those general journal entries to account for those. So make sure you're not preparing general journal entries for the unticked amounts in the listing of cash transactions. This is purely about the figures that have not been ticked in the bank statement. Now, as you record each missing transaction in the general journal, make sure you then tick it off in the bank statement to show that the transaction has now been accounted for. This process is very much about keeping a record as you go with ticking and things like that, so you're not doubling up or missing things entirely. Step 4, you then post those general journal entries created in step 3 to the ledger. And finally, step 5 is where you actually create the bank reconciliation statement. So this is comprised of the listing of cash transactions, unticked items, and then the bank reconciliation statement from that previous month. So the final figure in the bank reconciliation statement should match the cash at bank accounts balance in the ledger. So you created that ledger in step 4, and this provides you a bit of a check to make sure that you've done the whole process correctly. A bit like where earlier on in your accounting career, you would have seen that you would have done the process of general journals and then posting to the ledger. A check to make sure that you've done that correctly is to then post those entries from the ledger into your trial balance. And the debit and credit columns in that trial balance should equal one another, and that shows that you have done it correctly. Usually it would be very rare that you would get balance amounts without actually having it correct. So in the same way, this has sort of built-in mechanisms where you can check if you're correct, because that ledger figure needs to match the ending figure in the bank reconciliation statement that you create in this step 5. So now we're going to have a look at all of those steps in context. So we've got a fictional business here, and we're going to use the information that we've been given to complete the general journal, post to the ledger, and then prepare our bank reconciliation statement as at the 30th of June 2021 in this case. So here is the sort of information that you're going to receive. First of all, you've got your bank statement, and then you've got your listing of cash transactions. And we also have our bank reconciliation statement from the previous month. We can see that it's the 31st of May, and we're accounting for the 30th of June, so that's the previous month. And we've also got the ledger, the last line from the ledger, so it's just an extract there. So it's the last line of the cash at bank account we can see before the bank reconciliation statement is created. So that transaction there occurred on the 30th of June. It was sales, and it's important that we have that figure, the $7,740 debit figure there, because that will then be used later in the process of doing this bank reconciliation. So we'll see that shortly. Okay, so let's go through all of those steps that we just outlined, and now we are applying it to this specific business scenario. So step 1, we were doing that comparison between the credit column of the listing of cash transactions and the bank reconciliation statement from the previous month. So the bank statement's credit column and the listing of transactions, cash transactions, deposits column. So here we have then identified what items have not been ticked, and we've got the little extracts here. So if we have a look, we've got June 7, Duncan Industries for $44. If we go back to our previous slide, then we will be able to see that this this is where we got this from. So we can see on June 7 deposit Duncan Industries for $44 is in the bank statement, but then it isn't accounted for in the listing of cash transactions. So that is where we're getting that information from. Now let's have a look at the other one. So we've got items not ticked in the deposits column of the listing of cash transactions. We've got sales for $900 on June 1. So this time, if we look at that bottom chart there, listing of cash transactions, the first transaction there is sales for $900, like we just saw, but that isn't included in the bank statement. So you can see how we did that comparison. We found one deposit was in the bank statement, but not in the listing of cash transactions, and vice versa as well. And we've divided those up so we can clearly see what is missing from where. Now, something to note here, when you're comparing the bank statement with the listing of cash transactions and the previous month's reconciliation statement, make sure you're looking at more than just the dollar amounts. So you can see when I was reading that out then, I wasn't just looking for $44 or $900. I was looking at the particulars as well and the date. So you can also look at check numbers and payment numbers. So you can make sure that you're not getting mixed up between different things. So, of course, you may have the same amount for sales. It may be a recurring figure, and you could easily accidentally tick the wrong thing if you only base what you're doing off the dollar amounts. So, checking more than that is what is important here. Okay, so step 2. This time we're looking at just the same statements, but we're looking at the other columns this time. The bank statements debit column with the listing of cash transactions payments column. So again, we're dividing this up into the different categories. We've got items not ticked in the debit column of the bank statement, items not ticked in the payments column of the listing of cash transactions, and in this case, we also have another one, which is items that haven't been ticked in last month's bank reconciliation statement for $21 in this case. So now with that information that we have got, we now need to create our general journal entries. So making sure we're not creating general journal entries for the figures from the listing of cash transactions that haven't been ticked. So here we can see we've got our $44 for Duncan Industries and our $30 for our bank charges. But we don't have the, for example, $1,000 from Nourish Cafe or the $900 in sales from June 1st. So making sure to be aware of that distinction and only include the ones that you need. So as you record each of these, be sure to tick those off. So you would have written down something similar to what I had, where you were identifying what was not ticked. And once you have accounted for those transactions in your general journal, then make sure you tick it off straight away so you can make sure you're not doubling up at all. And now we post this to the general journal, to the general ledger. So step 3 feeds directly on to step 4, and we can see here why having that extract from the the ledger of freshwater organics from the previous month, the 31st of May, was important because in order to do the ledger, we need that final cash at bank balance from the previous month because that then carries through as our opening balance for this month, which is June. So that's where that $7,740 comes into play here. We are then able to go from that and add the figures that we found that weren't ticked in the earlier steps. So again, that 44 and that 30 from Duncan Industries and the bank charges. And then we've got that final debit figure of 7,754. And our final step is creating our bank reconciliation statement. So here you'll notice that the ending figure in that bank reconciliation statement needs to match what that ending figure was in the ledger. So again, we can see 7,754, we've got that match. So this is another built-in check to make sure that you're on the right track. If it doesn't match, then go back and have a look at where you may have gone wrong. Now, in this case, we've got that credit balance in the bank statement and the debit balance in the cash at bank account. So we could see previously we had that debit balance. We could see from that extract of the ledger, 7,740 debit, and that immediately tells us what we then put into this bank reconciliation statement as well. So all of these figures are then coming in. We have that $700 we looked at earlier and the $21 from earlier as well. So these weren't included in the general journal entries and the general ledger, but they are included now. So this is outstanding deposits and outstanding payments that we include here. Okay, so next up we have got cash budgets. This is something that is definitely going to come up in your cash management project. So the first part of this is these various statements that you need to be able to do. So apply accounting principles and processes, again, handwritten and spreadsheet, to prepare a cash budget, which includes our statement of estimated receipts from accounts receivable and our statement of GST payable and receivable. So what is a cash budget then? A cash budget is a forecast of what's going to happen in the coming months. So the projected cash receipts and cash payments, and then the resulting cash position for a month-long or a year-long period for the business. Oftentimes we see cash budgets over a couple of months, 2 or 3 months usually in our QCE accounting course. So only cash-based receipts and payments are included in cash budgets. As per the name, it is cash-based. And then non-cash items like depreciation, for example, aren't included. So that's something to really be aware of when you're doing all of these cash budgeting things, and when you're doing your cash management project, think about cash. We'll speak more about that later on when it comes to terminology that you use in your assignment as well. It needs to be cash related. Okay, so again, another example. So using the following financial information from Sheridan Industries, we are going to prepare a cash budget for September and October 2022. And we're given the debit bank balance from the previous month, September, which is $7,000. Our financial information is laid out there for those 2 months. We've got the payments and the receipts. what accounts are involved, and the figures for those. So what's the solution then? Now this is all about just plugging it in, plugging those numbers in to the correct format, really. So we have our normal format with our September and October columns. We start off with estimated receipts at the top, and then we put in what accounts are involved, in this case, cash sales and interest. You can see it's just an exact reflection of that financial information we were given. 16,700 for September, 3,040 for October. Then we add those figures up to get our total estimated receipts figure, before then having our new heading for estimated payments. And again, just taking that information directly from what we were given and having our total as well. Once you've got those totals for each of those things, it's then about bringing things together. So we look at the bank balance for the start of the month. We knew that it was a September debit bank balance of 7,000 because that was provided to us in the question. And then we've got, in this case, for September, excess receipts over payments. So how we figure this out is we're looking at that total estimated receipts figure and the total estimated payments figure. And we think which one's higher, which one's lower. If the receipts is a higher figure, then that means we've got excess receipts over payments, and then vice versa. So we can see it's the opposite in October, where we've actually got more payments, estimated payments, than we do receipts. And that's why the 1,040 is in the excess payments over receipts column, or row in that October column. If we head back to September, we can see that we also have the bank balance at the end of the month. So we had that 7,000 at the start of the month as a debit balance. And then with the excess receipts over payments, 14,700, we subtracted the 2,000 from the 16,700 to get that figure. And then we add the 7,000 and the 14,700 to get our end of month debit bank balance of 21,700. That 21,700 carries through as our new balance for the start of the month of October. And then in this case, we subtracted, so you're always subtracting the smaller figure from the larger figure. You're not going to get a negative number here. So in this case, we subtracted our estimated receipts from our estimated payments to get our 1,040 figure. And then we subtracted that from the 21,700 because that's the equivalent of a credit. We're decreasing that balance and it's going down to our 20,660, but we're still in the debit. The debit was being decreased by that credit, but it is still in the debit nature. Okay, so now let's zoom in to the statement of estimated receipts from accounts receivable. So the basic cash budget that we just looked at only involved our cash transactions. Now, this doesn't actually reflect the way a typical business is going to operate because, of course, inventories are usually purchased and sold on credit as well. It's not all about cash. We don't carry cash around like that. We often pay using a card. So there's generally a 30-day repayment period for purchases on credit, and the adjustments to the cash budget are necessary to account for those credit transactions. So this is where this statement comes in. It's attached to the cash budget, to overcome the issues associated with accounts receivable. It is a complicating factor having credit offered as well as cash because you're relying on people reimbursing you for the money that they owe you. So, some problems: the delay between the transaction, so the actual purchase, and then the receipt of the cash that is owed. The discounts potentially being offered for on time or early payments, and the possibility that accounts receivables will become bad debts, which means that they're not going to pay what they owe the business. So the statement offers a breakdown of when cash stemming from credit sales is anticipated to be received, and it's organized on that monthly time scale, similar to what we just saw where we were looking month by month, September, October, etc. So to generate a statement of estimated receipts, we need the business to use its prior experience to determine a few things. So what percentage of payments would usually be collected in the month after sale? So if something was purchased in June, then the month after sale is July, and then the subsequent months if the debts remain as well. We also want to determine what percentage of the debts will become bad debts, because that's also a factor as well. Some of them will pay in the month of purchase, some the month after, and the months after that, and then some people will not pay at all for whatever reason. So businesses aim to meet their financial obligations on time, of course. So accounts payable typically don't present issues like the accounts receivables do, and it's often not necessary to create a statement of estimated receipts from accounts payable. So that's why you'll be seeing lots of the accounts receivable statement and not so much of the accounts payable one. So let's now have a look at an example again to illustrate what we have worked on so far. So this is in relation to Quinn Sports. So using the information we've been given, we need to prepare a statement of estimated receipts from accounts receivable and a cash budget for June, July, and August 2022. So remember, they go hand in hand. The statement of estimated receipts from accounts receivable is attached to that cash budget. So the financial information we've been given. We have been told that Quinn Sports sells goods for cash and on credit. 80% of the business's credit sales are typically received in the month after sale, and they get a 3% discount as a reward for doing so. The balance of credit sales, so the remaining 20%, they're collected in the second month following sale, and they are not entitled to any discount. In April and May, our credit sales amounted to $116,000 and $120,000 respectively, and these are our anticipated sales for the upcoming 3 months, and we've got that divided with cash and credit there for June, July, and August. Okay, so what's next? Next up, we have got a little bit of information about our anticipated purchases. So the business makes all purchases on credit and pays its debts in the month following purchase to capitalize on a 2% discount. The anticipated purchases for the upcoming 3 months, we've got the figures for each of those same 3 months again. Then we've got a range of other expenses as well. $12,000 per month in wages, $1,900 per month in rent, $21,000 in rates, and $52,000 in land, will be paid for in June. So make sure that you really take note of all of the little nuances in the language. So you're going to be told specific months, or you're going to be told per month. You really need to take note of all of those things so you make sure that, for example, you don't just include the wages in one month and then forget them in other months, for example. And then we've also got our account balances for cash at bank and accounts payable on the 1st of June. So here we've got our solution. Now, this is the way that I liked to lay it out when I was at school doing this work. There are plenty of ways that you may choose to do this, but this is the way that made sense for me, breaking it down per month using the information that I had. So we were told in that financial information specifically that we got $116,000 worth of credit sales in April. And then 80% were going to be received in the month following sale with the 3% discount. So we've taken that, we've found 80% of 116,000 to start with. That was 92,800. And then we're applying the other information we've been given. We were told that those people who paid the business in the month following sale would be entitled to that 3% discount. And so we factor that in by subtracting that because we're not going to be getting that money. So we end up with a figure of 90,016, and that is going to be received in May. So the sales were in April, but we were looking at the month following with that 80% and 3% information. And then 20% would be received in June. So 23,200 was our 20%. And there was no discount for those who paid in the second month after sale, so that's why there's no extra calculation there. Now, I like to include the sentence at the end to make sure I'm reflecting when I'm going to be recording the information and when it actually won't appear in the statements that I'm creating. So I'm recognizing here the budget is not being prepared for May, so only the 23,200 for June would be shown in the statement that I'm creating. And that just makes sure that you are aware of what information is going to be included and what isn't. And you've got that sort of accountability there where you've written it down. And it's that same process for the following months. You were told specifically $120,000 worth of credit sales for May. We've got that 80% and 3% discount, and then the remaining 20% in July. I haven't got that extra sentence on the end because our cash budget was going to be for June, July, and August. So both figures that we found in that line, the figure for June and the figure for July, are going to be included. And likewise for the next one, however, when we get to the fourth one, we can see that we're acknowledging the statement is not being prepared for September, so only the August figure would be shown. And then the last one, we are actually recognizing that none of the figures will be recorded. So $131,000 worth of credit sales were made in August, we were told, but that is not applicable in this case because September and October would be when we would be receiving that money. And that's beyond the time span of this statement that we're working on, which only goes to August. So it's handy there sometimes to write it out completely, to show all of the working out and the figures, even those figures that aren't going to actually be included. And that helps you make sure that you're not missing anything in the process. As we can see, it can get a little bit wordy and a little bit complicated. So having it all written out can help you get your head around it a little bit easier. Now, on the flip side, we've got our accounts payable transactions, which is a little bit less daunting with the list we have here. So this is, of course, then based on what the estimated payments were going to be. So 26,000 worth of credit payments were made in May. We were going to get a 2% discount on that, so we've done that calculation there. 44,000 in June, and again that calculation. If we fast track down to the fourth point there, again we've got that line. As the budget is not being prepared for September, this payment would not be recorded. So here we have got our full solution now. We've done all of that working, and we've now been able to generate our statement of estimated receipts from accounts receivable and our cash budget. So on the left there, that statement of accounts receivable comes first, and we can see we're just plugging in all of those figures that we figured out in those previous slides. We're putting them in here. So this accounts receivable one is purely based on the first slide of working that we had, the accounts receivable slide. And we are making sure that the credit sales in, we've got the months listed down on that y-axis, April, May, June, July, August. And then you need to go across and look at where it's going to be received. So the credit sales in April, and the 23,200 was in relation to not the month after sale, but the second month after sale, and that's why it appears in June, not May. Not May, but June. Yes, and we can also see that we've got the totals as well. So we had our 93,000 and our 23,000 April and May in that June column, and we added that to create our total at the bottom, and we're just doing that same process for each column. Now, in our cash budget on the left here, we have got our estimated receipts. So those figures that we worked out for June, July, and August come across and appear as the accounts receivable figures. Now, you may have been wondering why we got some information about cash sales in the question, and this is why. We still need to put them into our cash budget, so that's why they are included across the top there. And then we do our totals again, total estimated receipts, and then we have our estimated payments. So all of the other payments that we looked at, we list here by account, and that same process then as earlier. You've got the bank balance from the start of the month. You've got your calculation that you figure out whether there's an excess of receipts over payments or payments over receipts. You put the figure into the corresponding row, and then you've got your end of month bank balance. So, for example, if we look at June, we had a $1,400 debit balance, but then we had more payments than we had receipts. So that debit column, that debit figure that's the equivalent of it being credited, because we're paying more than we are receiving. So that is then subtracting $2,060 from 1,400. And that gets us negative 660. We don't write it as a negative though. We just change the nature of the account, the way that it's written. So instead of saying debit, we say overdraft. So OD is an abbreviation for overdraft. That's the equivalent of having a credit bank balance because the business owes the bank money. We've overdrafted our balance there. And then you can see it flips around in the following month. We bring that $660 of overdraft across to July for the start of the month. But then we've got this influx and we've got more receipts than we do payments. And so then it's flipped around and we've ended up with a debit balance in July. So to figure that amount out, we started, so you can think of overdraft as being the equivalent of having a negative figure. So it's negative 660, and then you're adding the 25,204 to that, and that gets you the 24,000. Alternatively, instead of thinking of 660 as a negative and adding the other figure, you could just start with the figure 25,000 and then subtract the 660 from that. It gets you the same result. So it's about which way sort of resonates more in your mind with the way that you want to do it. So then we figure out, again, we've got the same situation in that August column where we've got receipts over payments, and we end on a figure of 79,000 in the debit for August. Okay, so now let's have a look at GST payable and receivable. So a majority of revenues, expenses, and purchases of non-current assets and sales of non-current assets attract GST for all of the businesses that are registered for goods and services tax. So generally in the month after GST is collected or GST credits received is recorded, businesses pay any amounts that they owe, and that must be allowed for in the cash budget. So this usually means that we need to have an additional statement called the Statement of Estimated GST Payments to the ATO, or the Statement of GST Payable and Receivable. So there's these different situations that mean that it's more complicated than just having that basic cash budget that we had as our first example earlier. We've also got the accounts receivables and payables to include, and we've got GST as a factor that complicates things as well. Okay, so this information relates to Blush Clothing Boutique. So another example to illustrate what we're looking at now. The business is registered for GST, and using the information we've been given, we're going to prepare a statement of estimated receipts from accounts receivable, a statement of estimated GST payments, and a cash budget for September and October 2022. So this is now our full picture. We're doing what we just went over before, but we're also adding this GST statement into the mix as well. Okay, so we've been told that it sells goods for cash and on credit, and GST applies to all of its sales. 85% of the business's credit sales are typically received in the month after sale. And the balance of credit sales, whenever you see the balance of, it always just means the rest. So you've got 100% is all of it. We were told 85% is a month after sales. So when it says the balance, it means how do you get from 85% to 100 to make it balanced? And in this case, it's 15% to get that equal. So 15% are collected in the second month following sale. Cash and credit sales for July and August, we've got those listed there, separated out for the months and the type of purchase. And then we've got the anticipated sales for the upcoming 2 months, September and October. So these were our figures that are set in stone, what happened in July and what happened in August. And then these are those anticipated figures that we've got for the coming 2 months, which are those predictions that we looked at earlier that the business needs to have those predictions for the future. We've also been told that rent received amounts to $6,600 per month, and the business makes all purchases on credit and pays its debts in the month following purchase. GST applies on all purchases, and we've got the anticipated purchases for the following 2 months of, again, September and October. Then we've got a range of other payments as well. So $8,000 in wages per month. We've got drawings each month and a range of other expenses as well. And the following, we've got the business's account balances on the 1st of September, which we'll need to complete the rest of the process later on. Cash at bank and accounts payable. So this is similar to what we were looking at before. So we've got our accounts receivable calculations and our working out for each of those. So we can see with each of these calculations, it's similar to what we had before. So we're taking the information that we were given in the original question, and we're using that to then figure out what the figures are for each month. So we know that we had $244,000 worth of credit sales in July, and then 85% would be received in August. So we can see in brackets we have figured out what that 85% of 244,000 was, and we're laying out when it will be received. It can be really complicated when we're thinking of the month after sale, the second month following the sale, all of these different months that are involved. So it's great to lay out the months really clearly like this. 15% were going to be in September, so we figured out that result as well. And again, we're specifying whether or not the figures are going to be shown. So as the budget is not being prepared for August, only the September figure is going to be shown. And it's the same process for the others, and we're recognizing when the figures will be shown and when they won't be shown based on what we've been asked in the question. We were asked in the question to look at September and October. That is why we have got the August and November and December figures excluded. But notice that we still do the working out anyway, just to make sure. If you don't do the working out and you get it wrong, you could potentially be missing something. So while it's optional, for example, to do that last line there, if you're really confident that you know it's not going to be included, then yes, you can skip writing it all out. But if you're unsure, then it can help to get your brain into gear to write it out in full like this. Now we've got our solution. So we've got our estimated receipts from accounts receivable, that same process that we saw before. We've got our cash budget, the process that we saw earlier, but we've also got our estimated GST payments to the ATO, the Australian Taxation Office, as well. So we have that similar process as before, where we're just plugging in those numbers that we found in our calculations. And it's also a matter, I suppose, of being really aware of the correct layout. Making sure that you know that September and October, the months that you're actually that you've been asked to look at, are across the top, and then you've got your other months that are helping to inform your predictions that are listed down the side there. Okay, so the next aspect of cash budgeting that you need to know about is this. So you are told in the syllabus that you need to be able to apply spreadsheet features and spreadsheet functions to prepare a cash budget, including input and report areas and a what-if analysis. So what do these mean? Let's have a look in a little bit more detail. So input and report areas. This is about identifying the financial information of significance and putting it into the spreadsheet in a really organized format. So the page of the spreadsheet where you do this is then used as the basis for the Excel formulas or the other spreadsheet formulas. You may use Google Sheets, for example. It's the formulas that you will use to do the calculations and prepare the cash budgets. So using formulas is really handy because if you've got a figure wrong, you can change it in one place and it will then adjust the figures everywhere else where where that figure had an impact with some kind of formula somewhere. If you have everything disjointed and you don't use the formulas, you just calculate it on your calculator or in your head and put it in manually, then you would have to change the figure that you've realized is wrong and then go all around everywhere and figure out everything that mistake would have impacted and address that. So using your formulas is a real time saver and also ensures accuracy. You can easily just figure out the right amount, but then do a typo when you're actually putting it in there, and formulas help you get around that. So if you're not familiar with how to put formulas into your spreadsheet, I definitely encourage you to do a little bit of research on that to get familiar with those things. So on the following slide, we're going to have an example for a business called Meadowbank Sushi Train. So information relating to sales, other revenues, expenses, and liabilities have been given, and each of the figures are displayed according to the month they are predicted to occur. So let's have a look. We've got our title at the top there, input or assumptions for the cash budget, the company name, and the time period. And then we've got the month breakdown of the receipts and the payments. So the months are across the top there. And then we've got what the actual accounts are that are involved down on the y-axis. And it continues on the left there. You've also got sales details as well below those receipts and payments. Now, a what-if analysis. This is about modifying the figures in the input area to get an insight into how this would influence the business's financial results. So you are likely going to be doing a what-if analysis as part of your cash project, where you have your initial cash budget, but then you fiddle around with the figures to try and help the business see what the best courses of action are with whatever the scenario they're in is. So, for example, the turnover of accounts receivable may be of concern to a business. Maybe they aren't getting payments quickly. Maybe they've got lots of bad debts. So perhaps in that case, you could change the turnover rates in the what-if analysis to better understand how doing so would improve financial performance. So if this happened, what if this happened? What would that mean for the business? If you have something that's of particular concern, you can then identify that and then try and adjust it in your what if analysis to prove how much of an impact making a difference in that area would have on the business's overall financial performance. So here is an example with a bit of a paragraph that you may have in your assignment explaining the process that you've gone through for your what if analysis. So you would be able to explain accounts receivable collection rates were modified in our first what if cash budget because of the inefficient cash collections and the excessive bad debts. So we're clearly stating what we are doing and why. And then we're giving details of what the initial rates were, 50% in the first month, 40% in the second month, and 5% in the third month. And then what we are changing those figures to. In this case, it's 75%, 15%, and 8%. And then we're explaining what the impact of this little experiment was. So it significantly benefited net cash flows with a positive payments figure, and you actually detail the figures as well. That's a tip that I would give when you're writing things like this. Try not to be really generic. You want to give the actual figures. You're talking about the money and about the percentages and about all of the results, so you need to give those results. It wouldn't have been good to just say that the rates were changed to 75%, 15%, and 8%. It's better to also mention what the initial rates were, so we have an understanding of by how much you've changed, and that informs the way that we look at the results you're talking about. So there was an excess receipts over payments figure, and a positive bank balance, and that is a significant improvement on the initial cash budget, which had a negative bank balance of $837. Bad debts decreased from 5% to 2%, and then that increased cash receipts from our accounts receivable. And then we finish off with a little bit of analysis and evaluation. So a procedure that may improve collection rates is implementing a credit policy. So we are thinking about potential things that could happen here. It's what if this could happen. So we've just modified our collection rates without sort of that actually having happened. We haven't implemented any strategies yet. So we're finishing the paragraph by looking at how we could actually achieve what we are suggesting in this what if cash budget. So a credit policy in this case could improve our accounts receivable rates, which is what we adjusted in this what if analysis. And then we're explaining that further. This policy may enforce a specified payment period with interest charged for late payment, and the creditworthiness of customers may also be ascertained before offering them credit. Okay, so your syllabus also mentions the computerized accounting processes that you need to be able to do. So synthesize and solve goal-orientated problems relating to cash management for a trading GST business. So the goal is to determine the optimum cash budget. We were just looking at this then, looking at how to adjust the cash budget to optimize it. Now, you could be provided with a whole range of different unstructured and unfamiliar financial data relating to cash management. So you could receive bank statements, schedules for accounts receivable and payable, information about the business and its activities, and an incomplete budget or an existing budget with negative bank balances. Okay, now to the computerized accounting processes. So you'll need to be able to use these to apply these to record transactions, and there can be lots of different types of transactions, all the sorts of ones that you would have encountered previously in other units in accounting. So opening entries, purchasing non-current assets, other revenues and expenses, etc., etc. You also need to carry out bank reconciliation, which is what we looked at earlier, but this is doing so in that computerized accounting format. Record balance day adjustments, generate end of period reports and financial statements. So, for example, our statement of profit or loss and statement of financial position. The implementing the end of year processes to ready accounts for the new financial year, and record or process reversing entries. So what are computerized accounting processes then? What does that refer to? These are the processes that you apply when when you're using software like MyOb, QuickBooks, or Xero to set up your accounts, enter transactions, and report your accounting information. So you will learn in class how to use usually just one of these platforms, depending on what your school selects, and you'll be learning how to do all of these things that you should be pretty familiar with in the manual written format. You'll learn how to do them in those computerized formats as well. So I thought we would include just a little bit of an overview of how to record a bunch of different transactions. So you need to be able to know how to use the accounting software. It's going to have a different interface where you need to know what buttons to click to get to certain things. But just being able to have that general understanding of the recording of the transactions to begin with is handy. So, for example, in that previous slide where it told us what we needed to know, one of the things was being able to do an opening entry. So that's what we've got to start with here on July 1, an opening entry where we have got all of our different assets listed in the debit column. We've got our credits with our accounts payable and our capital in the credit column, which they add up as always to equal one another out, those two columns. So that's an opening entry because it's the start of the financial year on July 1 in this case. We have got a purchase of furniture on credit. So furniture is our asset that's increasing. An asset is a debit by nature. So it's in the debit column, it's increasing, and so it stays in that debit column. Accounts payable is a credit, and that is increasing. Accounts payable is a credit by nature, so it stays in that credit column. Always think about what is the account that I'm thinking about? What is the nature of that account? So debit or credit? Is it increasing or decreasing? If it's increasing, then it stays as its nature. So if it's a debit that's increasing, then you debit it. Whereas if it's the opposite, then you do the opposite. So if it's an asset that's decreasing, then it is an asset that's being credited, and so you would need to decrease that figure and credit that figure. We've got the additional payment for the delivery of furniture. Watch out when you've got those little extra things that are said in the instructions. Sometimes they'll say you purchased furniture on credit and you also had a delivery fee, and it's easy to get the first bit and forget the second bit. So always be really vigilant for little things like that. We've got cash sales, cost price of inventories. So when you've got sales, you need to also account for the loss of those inventories that were involved in that sale. So when you're given the instructions for your general journal records, you will be told what the cost of goods sold is, and that will allow you to then do that second entry that involves cost of goods sold and inventories. Next up, we've got a few others. So we've got, for example, drawings on the 6th of the month. So drawings for $54. We've got the cash at bank for cash sales again, and inventories going down, cost of goods sold going up. We've got the owner withdrawing cash for personal use. So drawings, a way that I like to remember this is we know that drawings needs to be a debit because it starts with DR, and that is our little acronym for debit. So drawings is in our debit, and cash at bank, our asset of cash at bank is going down because money is being withdrawn for personal use away from the business and to the owner for personal use. So there's no GST um, for drawings transactions like this. It's just the two accounts. When we're paying accounts payable in full, remember our cash at bank is going down. That is our asset that's going down, so it's credited. And then the accounts payable, which is our liability, our credit, is going up, so that is credited. And let's see, we've got more different revenues. So, for example, on the 24th, we've got commission revenue. So, cash at bank is going up. Commission revenue is a credit by nature. And so that is credited because it's also going up. And you figured out the GST component of that as well. Remember that wages doesn't have GST. Keep that in mind as well. We can see that on the 30th of the month. It's simply just wages and cash at bank. Now, we've also got on the 31st there correction of error made on the 22nd of July. So we would have been told in our instructions that there was an error made on that date. So we've done a correction to address that. I encourage you to have a look at all of those in more depth, to have a look at the different things that were shown, and the interrelationships between different things as well. Try and backtrack and think, this is the transaction, so what would the instructions have been in order for me to then do that transaction in the general journal. Now we're moving on to have a look at some of our balance day adjustments. So we have got prepaid expenses to start with. These are expenses that arise from a business making payments in advance. So in the current accounting period, they are making a payment for goods or services that they aren't going to receive until the next accounting period. So maybe they make a payment for something in June, and then they're not going to actually receive that thing until the next accounting period in July. So, for example, you may make an advanced payment like this on something like a car, because you need to order it and pay for it to start with, but then you're not going to receive it for a while because it needs to be transported to you. So to record a prepaid expense balance day adjustment, you can have one of two general journal entries. It depends on whether the prepaid expense is increasing or decreasing. So we've got in our first one there the expense account increasing and the prepaid expenses decreasing. And then we've got the opposite for the second one. So it's really important to know the accounts that are involved, the nature of those accounts, and then think, is it increasing or is it decreasing? And that will help you understand what column it needs to be in, either debit or credit. So accrued expenses. These are expenses that are incurred in that current accounting period, but are yet to be paid. So these are a current liability. Wages and salaries are common examples. And to record this as a balance day adjustment, you need to have a debit to the expense account involved. So it could be wages, for example, and then a credit to accrued expenses. So the general journal entry increases the expense account to the correct amount, because we've actually got more expenses, and then it creates an accrued expenses liability account because the amount in the adjustment is owed on balance day. Unearned revenues is also another liability. So when a business receives revenue in the current accounting period that it will not earn until the following accounting period, that is when we have an unearned revenue. You haven't earned the money that you've received yet. So to record this, you want to have a debit to the revenue account and then a credit to the unearned revenue account. That's because both of these are a credit by nature. The unearned revenue account is increasing though, so it's credited as per its nature. And whatever the revenue account is, so usually you would list it in more detail. It would be rent revenue, commission revenue, whatever the case may be. And that is a credit by nature, but in this case it's decreasing because we haven't earned the revenue. So we're recognizing that it hasn't actually been earned yet by decreasing that overall revenue figure. So decreases the relevant revenue account to ensure it's representative of the amount that was actually earned in the period, because any additional money received belongs in the next accounting period. It belongs in the period that you actually earned the money. It creates an unearned revenue liability account because the amount in the adjustment is owed on balance day. Next, we've got our accrued revenues. So this is something that is not a liability this time. So I'll have a bit of a slide later with some tips, and that's going to show you a bit of a trick that I use to help remember what the nature of the different balance day adjustments are. But this one is an asset, so yet to be received revenues, but they've already been earned in the current accounting period. So in this case, we have a debit to accrued revenue and then a credit to revenue. The revenue is increasing, so increases the relevant revenue account to the correct amount, and it creates that accrued revenues asset account to represent that the business is owed money on balance day. So the accrued revenue account is an asset account going up. That is why it's debited. Revenue is a revenue account, a credit by nature. It's also increasing, and so you credit it as per the nature. Next up, we've got our analyzing, evaluating, and communicating components of the syllabus. So the syllabus says that you need to be able to analyze and interpret for a trading GST business the similarities and differences between a cash budget and a statement of cash flows, cash and accounts receivable data and information relating to the management of cash resources, a cash budget relating to the future liquidity of the business. You also need to be able to evaluate for a trading GST business, and this is again, just like other subjects like business and legal studies, it's about making decisions and proposing recommendations. In this case, we're doing so in relation to the effectiveness of internal control practices regarding cash management So you would be given information in the scenario about what the business is currently doing, and you're evaluating those practices to have a look at what the effectiveness is. Alternative projects and their impact on cash resources. So what could be done and what would the impact be? Alternative proposed changes to accounting practices impacting the cash budget. And you also need to be able to do this analysis and evaluation in a certain format. So in this project that you'll be doing, it is a business report extract to the manager of the business. So sentence and paragraph responses that communicate analyses, interpretations, evaluations, decisions, and recommendations, all of those things that we just went over, relating to cash management to business managers or owners of a trading GST business. And then a business report that communicates analyses, again, all of those things relating to that cash management. So I've included some practice exercises as well for the different skills that we went over earlier. So we had a look at bank reconciliation and we had a look at cash management. So I highly recommend that you have a go at these. If you can, try and pause the video and have a go yourself before you then access the solutions afterwards. This is going to give you the opportunity to go over something in full and then check to make sure that you've got it right afterwards. In this case, we've got Ellie Fashion, and we're using that same strategy as earlier, doing our general journal, our ledger, and our bank reconciliation. So we've been given all of this information, our listing of cash transactions and our bank statement. We've got our debit balance at the 30th of June 2021. And this is our solution. So I will skip over this to allow you the chance to do that yourself. Using the following information about Thomas & Sons agricultural supplies, we're then looking at a cash budget in this exercise. So prepare a cash budget for January, February, and March. We've got a credit balance of $4,000. So remember that layout that we looked at earlier for determining the figures for the different months and inputting those into the format of that cash budget. There is our solution. Now this one, exercise 2 for the cash budget topic, is a little bit more complex. So this is luxury home decor as our business. Using the information, we are providing our statement of estimated receipts from accounts receivable and our cash budget. And this time it's for 3 months, October, November, and December 2022. So we're given a bunch of information about the business and its sales and when the sales are collected and the anticipated sales as well for those 3 months that this needs to be based on. So we've also got some expenses as well and the anticipated purchases for the upcoming 3 months and the account balances like we saw earlier, cash at bank and accounts payable. Remembering that OD stands for overdraft, which means the same as credit. And we've got all of our calculations again. Again, I'll skip over those to give you the chance to have a look at those yourself. And if you're uncertain and you really aren't sure where you're at with those exercises, then you can definitely check out the solutions to help you along and perhaps work backwards to see what the solution is and how you can get there with your working. So next, we're going to have a look at a bit of an assessment overview. So this unit is all leading up to IA3, which, as I mentioned earlier, is a project on cash management. And so it requires you to develop a solution to achieve an accounting goal for a trading GST business. So there are a bunch of different goals that you may be doing this on. And this is an internal assignment, so your teacher would have written this assignment and would have chosen your business goal. So it could be expanding the business, it could be moving to a new premises, it could be implementing a new project like outsourcing, for example, or it could be purchasing a major non-current asset. So an asset that you're going to have for more than 1 year. For this assignment, you have 4 weeks, and that includes 7 hours of class time to complete the task. So in response to that desired goal that you're given in the business scenario, you are going to have a couple of elements. You've got your practical responses, which is the financial documents that you're going to create using those computerized accounting processes that we spoke about earlier, whether it be MyOb or QuickBooks or some other equivalent. And then you're also going to have your cash budgets, including the input area, where you've got all that base information in the first tab of your spreadsheet, your statements of estimated receipts from accounts receivable, and your statements of GST payable and receivable. You'll be able to generate all of those using that spreadsheet software. Make sure that you use your formulas. They're going to help you make sure that things are as accurate as possible. And it's also something that your teacher can look at too, to try and understand what you've done and how you've gotten the results that you've gotten, which can be handy as well. The second element is an extended response. So that is the form of the business report to the business manager or owner. It's 800 to 1,000 words, and it's going to involve all of those things we mentioned earlier: the analysis of the financial data, the interpretation, the evaluation of proposed alternative solutions, and the decision on what the solution should be and what your recommendations are. And all of this is in relation to that goal that you've been given in the business scenario. So the business report is providing information to the manager, and you want to divide it up into sections using headings. So being aware that the business manager may not understand all of the accounting practices, and so you need to make it understandable for them. But you also are making it formal. You're acting here as an accountant, as a professional, so you're speaking in language that reflects that professional nature of the report. So let's have a look at a QCEE IA3 sample response to see how to achieve these different syllabus requirements. So I encourage you to go to the QCEE website to have a look at all of the different resources they have there. They have got sample responses like this one. This one is a high-level sample response. They also have the different marking guides. They have the syllabus itself. They have different subject reports for each year. Often those things are accessed more so by teachers, but they do often explain how students are being marked, what sort of thing that you can expect for the assignments and exams you're going to be getting, So it can give you a bit of an edge over others if you are familiar with all of those things that the QCEE lay out that's publicly available there. And equally, do access those things for all of your subjects. It's all available on the website. So in this case, we've got a particular business. We've been given the context and the task. So Jared Jones is our business manager, our owner. He opened the business called Jim Supplies 3 months ago on the 1st of July 2019 as a sole trader trading GST business. So we've got the accountant, Frank, in this case, was appointed to set up the business file and record transactions in MyOb. So you would be acting as Frank in this case. And also he is to prepare cash budgets to guide future direction of the business. But after 2 months, Frank resigned. So he had only entered the transactions in MyOb for the first 2 months of trading, even though it's been trading 3 months. So acting as the business manager, Jared has employed the services of an accounting firm to complete the monthly management accounting for the business and provide advice on its operations. So this is where you come in. So Frank was the equivalent of you, but you are taking over from Frank now as that person who is giving the advice and doing those monthly processes for the accounting for the business. The task, so as the management accountant for the accounting firm, you need to enter the remaining transactions into MyOb and create cash budgets and related financial documents for the client's business. So use the financial documents to prepare work papers presenting the accounting data and information and to create an accounting business report. The report should provide Jared with advice about the viability of purchasing a delivery vehicle. This is that business goal that is central to the assignment. So it's been clearly stated here. And as I mentioned earlier, there are a whole different bunch of goals that you could be given in your assignment. In this case, it's the purchase of a non-current asset, a delivery vehicle. And then you're also looking at the impact of this purchase on the business's financial performance and position. So you've got that source there if you want to access this specific document where I got this information. So you can see here some of the requirements and how the assignment has met those requirements. So this is a high-level paper. It doesn't meet all of the top syllabus requirements. I think it's about 23 out of 25, but it is very close to being just right. So one of the most basic things that you should be able to get right if you have good attention to detail is think about just getting the features of the report genre consistently demonstrated. So you want to have things like your title page or your title section where you've got things like the business name, you've got your reference to what it is you're doing. So you've got a report to the owner with their name and what you're doing. It's about the viability of purchasing a delivery vehicle. And then you've also got ex-accountant. So you could be putting your name there, but in this case, it's been anonymized. And we can see here where all of those criteria come in, where you've got analyzing and evaluating and communicating. They're all relevant in the report section. The synthesizing and the solving and the applying are what you're going to be assessed on when you look at other elements previously. So using those computerized accounting processes, generating cash budgets, and solving all of those issues with those practical tasks. So here you can see we've got this this introduction where we're clearly stating what it is the report is doing, and so we want the thorough and logical explanation of issues. So we've got why the business is wanting to do what it's doing. So in order to offset the continual increase in the ongoing monthly delivery expenses required for sales customer service. So some of this is about you actually analyzing, and some of it is really just you picking out what information you need to explain to give the context at the start of your report. Now, every report is going to be different. Your different scenarios will potentially mean that you lay out your report differently. Your task sheet may have certain requirements that this one doesn't. So keep that in mind. This isn't the be-all and end-all of the way that you should do it, but it is great to have a bit of an example of where you can go with this potentially. So this report will evaluate the organization's current cash management position and provide viable cash budgets to forecast projected implications. So that is where we're looking at our what-if cash budgets. So the accounting data and information was examined from October 2019 to June 2020. It's always really important to mention dates so it's clear what it is you are talking about. And then you mentioned that you're proposing recommendations. They're based on available information disclosed during this period and are subject to competing external market conditions. So you can see that we've really got our terminology in there. It's formal. It's not in first person. We're writing in third person to get that really formal style in there. After the introduction, we move on to the overview. So this is where we're actually examining the financial data. Before we were just explaining in that logical way the situation. Now we're examining financial data through the identification of significant and relevant relationships. So, for example, we've mentioned we've got a current net loss, and this loss was attributed to marginal markup on sales items as evidenced by the cost of sales of $19,400. So something to keep in mind with this is don't just say things increased, things decreased, or this happened. Explain, go into depth, give the figures, support what it is that you're saying. So it's better to mention by how much something increased or decreased than just to generically say that it did or didn't increase or decrease. And you also want to give your ideas of why things occurred. So this loss was attributed to marginal markup on sales items, and then you providing the evidence as well. You could have just pulled that out of thin air, but you didn't. You're proving that you didn't by mentioning that the evidence is in that cost of goods sold figure. The business is in a solid financial situation as a startup business. So you need to not just say things like that, but then back it up again. So here they've got with total assets and limited liability commitments and the figures for each of those. So making sure that you're also succinct as well. The 800 to 1,000 words can be really tricky to stay in inside, but that is going to come into that succinctness category for the communication criteria. You've got some evaluating on this page. So perceptive judgments for proposed alternatives or changes relating to cash management. So earlier I provided that example paragraph where we had done our what if analysis and we had adjusted our accounts receivable collection rates. So that paragraph was exploring a proposed alternative or a change relating to the cash management. So the organization would need to seek external financing for the purchase of the asset. So financing the purchase of the delivery vehicle, we've got a really clear heading, and then we're talking directly about what that financing would involve. And then we think about the details of that. So if you are needing to seek external financing for the purchase of this asset, then a logical thing to think about is, does the business already have a bank loan? And in this case, it does, and it has a commitment of $2,100. It is of concern as to whether the business could acquire external long-term financing given its current short-term debt obligations and a reportable net loss for the organization. So you're looking at all of the current situation of the business, and you're judging what those things mean. So yes, it does already have a bank loan, which suggests, it is possible for it to get that external financing, but then you're giving the other side of the story as well. It may not be able to secure another long-term financing agreement with the bank because of its poor position in those other areas. Then it gives us the sort of what if kind of situation. If the external financing was approved, the business would attract a higher business loan interest rate. Therefore, the business would have to foresee a significant increase in sales as a result of the delivery service in order to justify meeting this additional significant debt commitment. It's thinking about all of the possibilities relating to financing this purchase of the delivery vehicle. It's all based around the goal, and you're looking at what the accounts are, how they are interrelated, and then you're analyzing those, evaluating those, and writing your report based on what you've found. So next we have our ongoing costs associated with a delivery vehicle. You can see we've got this logical progression of ideas. So we've thought about the financing of the delivery vehicle, and then you move on. So assuming that you've managed to finance the vehicle, it's then looking at the ongoing costs associated with that vehicle. So a logical progression of ideas. Purchasing a delivery vehicle requires ongoing maintenance and associated costs. So then you're looking at different figures. We've got the historical cost, and the fact that that needs to be disclosed in subsequent financial periods. We've got an allocation of sales salaries would have to be costed. A decision would have to be made as to whether 2 staff would deliver the inventories. Therefore, the budget has been adjusted from 120 hours to 152 hours to recognize this. And then it's giving the figure for how much of an increase this is in expenses per month. So this is looking at a bit of a what-if situation here. Instead of changing the accounts receivable collection rates, like my example paragraph earlier, this time we are changing our wages with the number of hours worth of time we need to pay employees for. A delivery vehicle expense account would be created to disclose ongoing fuel and maintenance costs, and these expenses have been forecasted as 15% of total sales. So a really clear explanation of everything that is being done. Another thing that you can do is you can have your figures within your report to provide the visuals. And this really helps with making sure what you have written is easy to understand. So expenses without the vehicle is in red, expenses with the vehicle is in blue. We've got a really clear comparison to show what the situation would be in each of those scenarios. And then looking at that over a longer period, not just for 1 month, but over many months there. So that factors into that idea of being succinct when you've being able to put your information in a really easy to digest format like that. Then we've got a cost benefit analysis for the delivery vehicle. So we're looking at trends in the financial data and information. And we are explaining everything with figures as usual. Something that they've got in the commentary on the side is we've got awareness of no increase in advertising expense. So advertising expense should increase to reflect a possible reason for this distinct increase in sales as from October 2019. Acknowledges trend history to inform unrealistic increases in cash and credit sales. So I encourage you to really pull apart all of the comments that they've got down the sides of these different samples on the QCEA website. You can see what was done well and what was potentially missed or what could be improved on, and that can help you with making sure you learn from it in your response as well. Again, another chart that we've got there with our cash at bank trend analysis. If the delivery vehicle was purchased outright, and we've got the discussion of that, and then the clear visualization as well. So again, really clear communication here. But then acknowledging all points of view. So we've said that the cash at bank account would be recorded as a bank overdraft until January 2020. However, this option would not be supported as the interest on this overdraft facility would be significant and the business would be restricted from accessing physical cash funds quickly. So it's showing a really good understanding of the processes of what would happen if this scenario was real life. And then our conclusion and our recommendations. So you can see the recommendations are formatted as points. So the equivalent of dot points, but laid out with the 5.1, 5.2. So it looks very professional. Convincing recommendations for cash management pertinent to the accounting context. So to finish off, let's have a look at some tips that you can take into the rest of the year for accounting. So like I mentioned earlier, it is really important to use your cash-related terminology. So unless you're referring to information you've been given that isn't cash-related information, make sure that you use cash terminology. So for example, instead of using outlays or expenses, use cash outflows, for example. And I've done a little bit of a cash budgeting word bank here, so you can see what kind of words and phrases you should be using in this assignment. So as you can see, a lot of it has the word cash there. Cash receipts, cash balance, cash collections. So instead of saying that, so let's have a look. How would you change the following sentence so it uses cash-related terminology? Accounts receivable collection rates were modified in the first what-if cash budget due to insufficient reimbursement and excessive bad debts. So what is the problematic phrase there that's not a cash-related phrase? I'll give you a moment to think, and we'll come back to that in a second. So use it and its when referring to a business, not they or their. So when we're talking about multiple businesses, we then say they or their, because it becomes plural. But if we're talking about a singular business, it's an it, not an they, because it's not a person, it's a thing. So that's why we've got that distinction. Like I mentioned earlier as well, be specific. Don't tell us a figure has significantly increased or decreased without specifying by how much. And also, if you can, thinking about why as well. Write in third person and avoid your emotional language. This is writing a business report to a manager or an owner. You're not wanting to be in English, generating an emotional response from an audience. So don't use words like horrific situation. You want to be more neutral than that. You're professional. You're talking to the business owner. So you don't want to dramify what you're talking about. You don't want to alarm the person. If it was real and it was really their business, then they really wouldn't appreciate being scared by what you give them in your report. It's honest, but it's in that language that is appropriate for the context. So in that practice question that we have there that we looked at, insufficient reimbursement is the problem here. So reimbursement specifically is the word that we want to change. So insufficient cash collections could be what we replace that with. And then some memorization strategies that I mentioned earlier. So with our balance day adjustments, we've got our different accounts, and I mentioned that I have a bit of a strategy for remembering what ones are assets and what ones are liabilities. So I remember that pairs are assets. So pairs stands for prepaid expenses and accrued revenues. If you know that pairs are assets, then you know that your other two accounts, so your unearned revenues and your accrued expenses, must be the opposite. So those are your liabilities. And then we have GST, a strategy to help you remember how to calculate that. If it is included, you divide by 11. If it's not included, you divide by 10 to find the GST component. So, for example, when you are working with bad debts and you are given a figure and you're told that it's inclusive of GST, you need to then find the GST component to take it out of that figure, because that you then need to put into your financial records. The bad debts figure should always exclude the GST. So because it is included, you're told that it's included at the start, you divide by 11, with I representing the 1, 1. And then it's the opposite. If it's 10, not included, you've got the O in not representing the 0 in 10. As I mentioned earlier, drawings are debited, and the DR in drawings helps you remember that because debit, the acronym for that is DR. Some general tips to finish off. Definitely recommend accessing the QCEA's resources. It is super important to be across all of the requirements for all of your courses, and it is completely laid out for you in very clear, detailed boxes and tables and everything in the syllabus. So I encourage you to have a look at that. Now, they are really long documents and that can scare you away, but just jump to the sections that are relevant. It's going to have assessment overview sections. It's going to have topic overview sections where it tells you everything that you need to know for each topic that you'll be doing at school. And it also has a glossary as well. and that can be really handy if you want to try and understand the terminology that they may be using in the criteria and stuff like that you may not be familiar with. Using the syllabus as a study guide is really handy because, like I said, they mention everything that you need to know. They can't assess you on anything that isn't in the syllabus. So if you have the syllabus down pat, then that is going to really set you up for success. And then use accounting terminology in that appropriate tone of voice, like I mentioned earlier. Don't make it doomsday. Make it that neutral kind of tone, that professional tone, and use that accounting terminology. And in this case, the cash related terminology, because it's about cash management. Thank you so much, everyone, for coming along today. I hope that today's lecture was really useful for you. Good luck with the rest of your studies, with all of your subjects, and I hope to see you in future lecture series. Thanks, everyone. Bye.